Hello, good people.
Hello.
Hello.
Hello. Dr. Sanders, how are you?
I'm doing all right.
Are you ready for my great granddaughter?
No, I saw her today and avoided seeing her.
Let me tell you something, man. Don't mess with my people.
I went the other way. All right, everyone. We're going to start our meeting today. Our investment committee meeting on what's today? The 20th, Thursday.
Okay, we are live.
All right, we're ready to start our investment committee meeting today. And it is 4:30 on the dot, and we're ready to go. Can we get a roll call vote? Sue?
Christina Bennett. Candace Carter Oliver.
Yes, present.
Louis Cross on his way. Kelly Dobell. Mary Donaldson. William Heisey.
Excuse me, not. Do you think Mr. Cross?
You want some pepper?
Shanice Johnson.
I think he's on his way.
Present. So I'll give him a few more.
Okay, thanks.
Yvette Levy. Jennifer Orr.
Yes.
Albert Sanders.
Present.
Andrew Vian. Doris Walker.
Here.
So we do have 5. We do have enough for a quorum. So I don't know. Dr. Sanders, what your pleasure is getting started?
We are ready. We're ready. We have our investment team here. I think, Sue, I think that's where we're going right now.
Great, fantastic. So I think what we have first on the agenda, we have Cohen and Steers. So I think we're going to go into closed session in a second here. But before we do that, I'll just give everybody just a quick update. So this is a real estate manager, and in particular, what they're going to talk to us about today is a product that they have that would essentially be able to acquire the units of UBS that we were looking to potentially liquidate at some point. So they're going to walk us through the mechanics of how all of that works. So with that said, I'll kind of hand it over for closed session. So do you want to pull that up, or let me know when you want me to pull it up?
Yeah, and then afterwards.
Okay,
we'll give that other
gotcha.
notice. So it's the first motion there.
I move to close the meeting that all records and votes to the extent permitted by law during the closed portion of the meeting be closed pursuant to section 610.021 subsections 1 and 2 of the Missouri Revised Statutes for the purpose of having a confidential or privileged discussion on contract matter.
Second.
Okay, so I can move forward with a roll call vote. Candace Carter Oliver.
Yes.
Shanice Johnson.
Yes.
Jennifer Orr.
Yes.
Albert Sanders.
Present. Yes.
Doris Walker.
Yes.
Okay. Let's see what we got in the room. So we do have 5. The motion Carries. Let's let Christina in. All right.
Good afternoon, everyone.
Good afternoon.
Hello. All right, so let me do a couple things to get us off live.
While we're not recording, I just want to make sure with the new, I knew it.
All right, we are live.
You go.
Which one do you want to do first?
Right, hey, Guelda, so just in the interest of time, do you want to go really high level on the quarterly, and I'll hold sort of any market comments until the July report, because that's going to be.
That's fine. If you could bring up the performance report, Sue, the quarterly. Okay, you can move forward to the section that has the I don't know how I have my word, that page. Okay, what I want to say, just to briefly frame how things were in the second quarter of the year, as you can see here at this top graph, everything's positive. We had a really good for second quarter of 2026. And as you can see here, small caps did extremely well, and so did emerging markets. As you see, fixed income is positive, but definitely that was not where your returns came from. The AI trade is what is really driving a lot of this in the domestic markets. And in the emerging markets, Taiwan, I believe it's Taiwan and Korea, I think actually drove a lot of the returns in the emerging markets. As mentioned earlier, there was some question as to whether or not we were going to get a rate cut. An interest rate cut. With the way the economy is going, we're probably more likely to see a raise in the interest rates, even with the new Fed chair. Of course, President Trump wanted a cut, but the market conditions don't warrant a cut at this time. If you move forward, Sue, to page 12, we'll get to the meat of the matter of the fund itself. As you can see here on page 12, all of the segments are within the target ranges. And as you know, the target ranges are the asset allocation is the biggest determinant of you meeting your asset allocation, you mean actuarial return rate of assumption. So everything is in line right now. As expected, fixed income is a little low due to the run up in the equity markets. You can move forward to page number 13. As you can see here at the top of the page, we had a very nice increase in market value from the end of March to the end of June. Move forward to the next page. And the commissions. Commissions on page 16. Only thing I would say here, everybody is pretty much on target or above target. Systematic is slightly below what we asked for minority women, disabled business enterprises at 28%, but we're still only halfway through the year. So I think everybody will meet the commission targets that have been asked for in each of the different segments of the market. You can move forward, Sue, to page number 18. This just outlines the cash flows during the quarter. And as you can see at the bottom of the page, nice run up in market value. See where we ended at the end of the beginning of the end of March. And then you see we had over $72 million in capital gains in the fund to bring the fund to $975 million in the end of the second quarter of 2026. Page 27 gets to the actual returns of the fund. As you can see here, the fund returned very well in the second quarter with basically 8% return, just slightly below the policy index, and it ranked 66 among peers. The 1-year return and are above the policy benchmark, and the fund ranks well among other funds like it. The long-term returns are good for the fund. And as you can see here, in the furthest out, you can see the fund ranks 21st and has an inception return of 7.23%. In domestic equity, we had a return of 14.64. It's below the policy index, but still a good return. The 1-year return, as you can see here, is 25%, and it ranks above most other domestic funds in that time frame. When you look down the page, as you can see here, where we saw weakness in the second quarter of the year was in 2 different active managers. Edgar Lomax, as you can see here, a very high quality value manager, had a tough time at 3.64, significantly below the Russell 1000 value in the quarter. Their market commentary said that they were the riskier stocks is where things really outperformed. So we have that manager, as you know, on watch, and we did move part of their assets to the index. So what we're looking for in Edgar Lomax is when the market index starts to turn negative or performs poorly, we look for active managers to actually shore up in those times. And I think you'll see that in the July numbers. The next manager that we have is on the next page, TCW. As you know, that the growth managers have had a hard time beating the Russell 1000 growth due to the concentration of that index. TCW, as you see here, had a good return of 14.2, but not as well as the Russell 1000 growth. They've actually come to us with a proposal that we're not in support of. They want to increase the allocation or percentages of individual stocks, which Jeff and I don't feel is prudent. So that's probably something we will tell you. We'll present it as asked, but we're not going to suggest that you do that. Down in the next section, we're looking at small, mid, and micro cap stocks. As you can see here, they did well, but not as well as the respective indices, with the exception of Systematic. Westfield 20.8, Systematic 20.9, DFA 20.3, all good returns, but the only one that outperformed the index was Systematic, and they ranked 18th. But if you look at the long-term numbers on all these managers, there's no concern there in that small, mid, and micro cap area. Going down the page, we have Fidelity in the growth component of developed markets and Causeway on the value side. As you can see here, Fidelity didn't do quite as well, ranked 44th, though did well versus other international growth style managers. Causeway, your international value manager, did well, very well at 12.8, and they ranked 22nd. No concern with either of these managers going forward. Sue, if you move to the next page. Here we've got the emerging markets portion of the fund. DFA is your current emerging markets manager. As you can see here, the return is 16.9, not quite as strong as 16%, not quite as strong as the MSCI Emerging Markets Index, but a good solid return. That manager has had mixed performance, as you can see here, over different time periods. Exponence, as we know, we have Exponence has had some challenging times where they're continuing to build. And as you can see here, the numbers are starting to come up. They were slightly off of the MSCI ACWI World at the end of the June quarter, but rank well versus other world managers at 41st. You can move forward, Sue, to the next page. Here we've got fixed income. Fixed income actually as a group outperform the custom benchmark here in the second quarter of the year. You're looking down the page, you can see here, the managers are either in line or above. As you can see, Ernest was pretty much in line, off by 3 basis points. Manulife was in line, but your star in the core area was Loop Core, the Core Plus manager, and they ranked 4th. All of the core managers are doing fine on a long-term basis, so no concerns there. Opportunistic fixed income, as you can see here, Loomis did well during the quarter. TIPS, of course, that's just a mimic of the TIPS index. Neuberger Berman, slightly below, but excuse me, I can't hardly see that. No, Neuberger Berman did fine. And Wellington Multisector was your star performer with a return of 3.48 and ranked 11th. Move forward, Sue. GTAA PIMCO All Asset Fund. This manager, we've had challenges up and down, up and down. As you can see here, this quarter not so good. But if you look at the fiscal year-to-date number and the 1-year number, they're actually starting to improve. And as you can see, their fiscal year-to-date, they ranked 41st. But we are watching that fund very closely. And then the next section is hedge funds. As you can see here, for the managers that are still actively managing, Entrust is basically in liquidation. Both Whitebox and Grosvenor did extremely well this quarter, with Whitebox having a return significantly ahead, and Grosvenor just knocked it out of the park at 17.1 versus 7.6. Next page. Real estate, we just talked about this quite a bit. As you can see here, as we mentioned, the Trumbull Property Fund actually was in line with the Odyssey. The U.S. Trumbull Property Income Fund was slightly below, but the more recent returns of this manager have actually started to dig out of the hole that they were in. Trying to think what else. Oh, and another thing is we normally don't talk about it, but on page 85 of the report, you can see what the private portion of the fund actually has returned collectively over time. Page 85, go back. Go one more up. Okay, at the top of the page, you can see the internal rate of return. They've added 10.4% internal rate of return to the fund with a multiple 1.4. As you know, this is a relatively young private portfolio, but it is adding value to the plan over time. I won't go so much into what we would normally do. We would normally go into the managers on watch. The ones that we really have consideration that we're going to continue to discuss and watch that we have concern about are TCW, Edgar Lomax, and the Exponence portfolios. Any questions before I turn it over to Jeff? Hopefully I didn't go too quick.
Great. So let's go a little more current here on the July monthly report. And again, I'm going to keep this high level in interest of time, and again in keeping with Bobby's directive. You know, it was actually a little bit of a negative month, so not big, but negative enough so to cause me to have to give this report. So in any event, first page, Sue, is just quickly take a look at the markets, and you can see it was a little bit of a mixed bag, but what was most apparent just for the month, if you pay attention to the 2 top left tables in the equities, a bit of a reversal from back to that risk off situation of thing. You remember that for the quarter, we saw better things from the small cap stocks and emerging markets, and we did see a reversal in that trend and the continuation of those technology stocks doing really well. Well, those are the things that tended to sell off the most in July here. So Russell 2000 was down over 3%. The Russell 1000 growth, that's that very technology heavy index with a lot of those AI names. We saw the sell off there. And then the emerging markets, you can see also down about 3%. So we've just continued to see that back and forth between the market sentiment and everybody liking certain things and then going back to the table and saying, well, let's go after stuff that's a little bit cheaper now. So again, that's, when we think about the portfolio construction and the things that we've done over the past couple of years to reduce risk and diversify, it's really been designed to help us manage around these things and these different cycles and to be well diversified. So again, that's what kind of leads us to, once we get to the performance page, of seeing, even when we have a down month where there's things that are down, almost 5%, like the technology stocks, that because of our diversification, we're really, have seen some good minimization of that downside. So again, we're pleased with how that has gone. That second table right below on the left, that's the fixed income indices. You can see those were by and large negative, depending on where you looked in the environment. Again, we talked a little bit about interest rates before when we were talking about Cohen and Steers. When we do have an environment where we think interest rates might be going up before they come down, that tends to give a little bit of pause to the overall fixed income market. So that's been what we've seen here. So another thing I'll point to, and again, this kind of comes to what we expect from interest rates and inflation and the things that we're keeping an eye on, that if you go to the right side of this page and under the table that says commodities, and again, you can see oil prices and where those were at the end of July at $85 relative to where they were just to begin the year, over $57. So that's something, again, they've been as high as 100, and every time we continue to see more of this stress and what's going on in this conflict in the Middle East, that's when those oil prices tend to hover a lot higher. Well, ultimately that creates sticky inflation. Oil prices are high, gas prices are high. That impacts all of us and as consumers, and the more we have to pay for gas and other things, the less we have to spend at other places in the economy. So that's what the Fed's paying attention to with their rate policy, and that's when we talk about interest rates potentially going up. It could be to fight that inflation. So sort of keep that in mind as we talk about things going forward. Sue, if you want to flip forward one page. Again, this is the asset allocation picture. This is not going to look too different from what Gwilda showed you. Again, we're going to be within all of our tolerable ranges. Those are the shaded areas. Again, upside down triangles. Those are the current allocations. Any of the rebalancing that we do on a go-forward basis for cash flow needs will certainly come from the places that are more overweight within the structure. Again, we tend to do those rebalancings in a little bit more of a lumpy phase, but again, we're pretty well within all of our guidelines here. So international equity be the one that has the most overweight, but still within our tolerance, and then the core fixed income allocation is going to be a little bit lower. So again, as we go through the next couple of quarters, take a look at reallocations and rebalancing. Those are the areas that we'll focus on the most. But again, no recommendations for wholesale asset allocation changes today. Sue, for one more page. Again, so top line performance for the month, you see we were slightly negative, down 0.36%. So I like to call that flat, not wasn't a big negative return relative to where some of the other areas of the market were. Again, if you factor in also that we don't get real estate numbers on a monthly basis, but real estate has generally, by and large, been positive on a monthly basis, that's probably going to get us closer. It's going to move us a little bit more positive if we factor in a real estate return. So again, with that kind of volatility going on, not a bad place to be. Fiscal year to date basis, we're over 7%. Latest 12 months, 14.5%. And then you see where the 3-year number, nice at 11%. The 5 years is still a little bit below our 7% return target that we like to stick to for actuarial purposes. The 10% has some nice cushion above that. And then the inception number, which is going to be a longer term picture of where we expect and where we have been and where we think we can be on a go forward basis. Nicely in line with that overall expectation. So again, we take a look at relative returns, in particular for that 5-year number being above the policy. In that 5-year, we like to focus on that one because that's about it's starting to be the time that we've been in place. So again, we're starting to bear fruit from a lot of these changes we've made structurally with the portfolio, again, to reduce that risk, to tighten up things relative to that policy benchmark. And certainly being above that policy index for that period is great for us. And certainly we'd like to see those absolute returns come up and be much tighter to that 7% assumption. But again, all things moving in the right direction. Again, not going to spend too much time on some of the individual managers, other than some of the things that we did talk about. So TCW, which Gwola had mentioned being on watch. So they were pretty flat for the period relative, to a month where the large cap stocks were down quite a bit. So they made up a little bit of that gap there. But again, on those long-term numbers, certainly still have some ground to make up there. Sue, flip forward one page. The small cap, again, we talked about before, was one of the areas a little bit more challenged in the month, but those longer fiscal year to date, 1 year, 3-5, some of those numbers still look really good relative to the overall benchmark. We can see where the international markets developed as a group, a little bit behind the index for the month. The emerging markets I talked about before was one of the more challenged areas. So DFA was sort of right along with that of where the index was. Exponents, again, that's one of our big watch list items. I know we've had a lot of conversations about them. So making up the gap and on a 1 month basis, and you can see on a fiscal year to date basis, they do have a nice cushion above the benchmark through July. So we want to continue to see those improvements. You see on the latest 12 months, they've started to tighten up that gap a little bit. The 3-year and 5-year gap is still there, as well as on the 10-year basis and inception. But again, we recall the time frame that we did sort of agree upon with them. So we've got about 1 more quarter to see what improvements could lie ahead. Otherwise we're probably having a discussion about thinking about other options for that allocation closer to the end of the year. So let's kind of keep an eye on that, and hopefully we continue to see progress from that manager.
One thing I would add here is, if you see here, Ernest Partners was funded at the end of July. So the August flash report will include that new manager.
Okay. Great. Thanks, Gwola. That's a good point. I did miss that. Fixed income page, moving forward again, that was slightly negative as a group, down almost 1%, and it was fairly evenly dispersed across the board. Those global opportunistic managers doing a little bit better on an absolute basis relative to the core managers. But again, all of them pretty much faced those headwinds of potential interest rate increases looming. Again, those longer term results of some of those fixed income managers, the 3-year number being a little bit more indicative of the higher level of coupons that we've had being issued from bonds. And again, you see the opportunistic portion has done very well relative to its benchmark. And even those core managers, while the returns aren't as eye-popping as what we've seen in the equity market, still have a nice margin above their benchmark over that latest 3-year period. So again, we're pleased with how that overall construct has worked. The global GTAA managers, PIMCO, they were slightly ahead for the month. Their fiscal year to date basis and 1-year numbers are both solidly ahead of their benchmark. But again, I know our tables and our risk metrics are still flagging their 3- and 5-year performance. So again, if we continue to see the improvements we've seen over the last 12 months, then we should see them start to come into check on the compliance matrix, and then your hedge fund managers right below that. And again, the following page is just real estate. We don't really have good updated numbers there, but again, it was sort of a mixed bag of a month. August has been a bit better. So the large cap and the S&P stocks are positive. By and large, a couple percent. International stocks are even more positive. And then fixed income has been bouncing around a little bit in negative territory. But if things stay where they have been for the month of August, it should be another positive month. And again, as we think about the market value of the plan, this will be another one of those months that gets us a little bit closer to that $1 billion mark. So, which we're all going to have a nice celebration when we hit that. So. And that's it. So again, other than the watch list items that we talked about. No hard recommendations for any changes today. So entertain any questions, comments?
I would only say or thank you. That's a good update, and overall, I think positive. So thank you.
Great, thank you. Well, I believe that's everything we have on our agenda.
Well, thank you very much, and thanks for bringing us the good bad news, but or the bad good news as usual, Jeff. Thank you very much. But I think at this rate, Sue, we don't have anything else, correct?
That's correct.
All right, I think we're ready to adjourn our meeting for today, our investment committee meeting. Can somebody give us a motion to adjourn the meeting?
So moved.
Second, somebody?
Right. Now ask me, am I gonna retire here? No.
Second, Candace.
My goodness, y'all don't want to get out the meeting?
Second, Candace.
All right. If there are no other questions, all in favor?
Aye.
Any opposed? Abstentions? Thank you all for another great meeting and look forward to our next meeting.
All righty. Thanks, everybody.
Thank you.
And
Thank you.
happy
Enjoy the
happy
start of
new
school year.
yes. Monday we
New
get them
Year.
kids. Happy New Year, Dr. Oliver.
Thank you.
Pleasure to meet
All right.
everyone.
All right. Nice meeting you, Mary.